you sat down and you said, hey, it's getting too easy. You just throw money in the market and you make money. Is that how it's going to be this year?
It does seem easy, and assets across the board did well last year. It probably won't be the same this year. When we think of the bond market, which has been PIMCO's chief focus, it's not likely to be the same. Last year was a turnaround year for the bond market after a more difficult and challenging 2018 when the Federal Reserve was raising interest rates. But the key component that drove returns in 2019 probably won't be a main driver this year, which is a decline in interest rates. Interest rates in 2020 are more likely to be stable. Credit spreads, the difference in yield between instruments other than treasuries to treasuries, probably stable too because of the ongoing economic expansion, which probably means that 2020 can be characterized chiefly as a coupon clipping year where neither prices move because of interest rate changes or there'll be meaningful price changes because of credit spread changes. And so, but the main thing, last point, is the risks lean toward one side, which is toward wider credit spreads, not higher interest rates. So if there's risk in the bond market this year, it's sort of somewhat widening credit spreads, and who knows what type of event, because there still are numerous uncertainties for this year, political, trade, and also the election that could affect the market.
Forgive me, Margie, for mispronouncing your name in my introduction. I beg your pardon for that. What about your outlook for the market this year? As Tony said, almost every asset class made money in 2019. What's going to be the best investment in 20?
I think stocks will be the best investment in 20, just as they were in 19. I think people are underestimating the positive forces behind the equity market. The first one being that the Fed has changed their game plan. They're no longer meddling in the market, causing uncertainty, and I think that opens the doors for equities to continue to expand on the upside.
Well, Margie, I mean, implicit in that, if the idea that we're still in this one, let's say 2% growth economy, earnings are single digits, if it's going to be a very good year for stocks, that would suggest that we're going to expand valuations and kind of get a little more excitable in terms of investor enthusiasm. Does that seem like a likely scenario?
I think it's a likely scenario, whether stocks go up because of earnings going higher, because of PEs, price-earnings ratios expanding, or just a relative shortage of stocks and lack of bad news. That says to me that stocks are likely to continue to surprise on the upside, especially when so much money is positioned as if tomorrow there was going to be a recession. That money is still poised to enter the market, and that's going to keep us from having any deep correction, I think.
Tony, going back to your outlook for the bond market, what does that mean in terms of, or how should investors be positioned within fixed income more broadly, and particularly versus other types of assets?
First of all, don't try to market time the diversification benefits of bonds. Many believe the Federal Reserve this year won't cut interest rates, and that's what the bond market's priced for. So many bond investors will say, well, why am I invested in bonds with yields so low globally? Well, there's something called conditional correlation, that when something bad happens, bonds will be there for you and for your portfolio to benefit the portfolio. Because the key risk for any investor in the entirety of their portfolio is equity risk, that equity prices decline, that the equity risk inherent in certain corporate bonds and other bonds hits those bonds. And so you want to have fixed income simply for the diversification. But all that said, what we would suggest is being liquid, resilient, and agile in terms of portfolio construction. This means going up the value chain, sticking with more high-quality bonds, because bond market's priced for perfection, and there isn't a lot left in terms of yield above treasuries.
Margie, what do you see as the biggest risk to your investment thesis for 2020, given the fact that there are so many uncertainties right now?
Well, I would think the biggest risk would be that some countries, emerging markets, China perhaps, disappoint in their growth prospects. I'm thinking that most countries will slog along and have modestly positive growth rates. But if we had a real correction in one of the major emerging markets, that could roll over a little bit onto our markets. But really, the U.S. market has such strong fundamentals. I think that'll be a pretty immaterial negative force on the equity markets.